Okay, now we shall go ahead and take an example on CVP, that is a cost volume profit analysis. And this question is a very old CPA examination question, which I found in a book written by a very popular author, Jain Narang. Okay, I've just taken this question. This is a likely candidate for an MCQ, right?
Yes.
Now let us go ahead and take on this example. Learn this really well for your examination. Here we go.
The cost, volume and profit relationship of a company is described by equation y is equal to rupees 3 lakh plus 0.7x, in which x represents sales revenue and y represents the total cost.
You all know that y is a total cost. We know the total cost can be broken into two parts. The first part is what? Fixed cost. And you have variable cost. That is going to vary with the unit sold or with the sales revenue. In this case, I say y is the total cost. And then 3 lakh should be your fixed cost because it is constant, rupees 3 lakh. Plus, now they given 0.7 into x. What is x? Is given as sales revenue. We all know that variable cost is expressed as a percentage of sales revenue. That means in this case I can say the variable cost is 0.7 or 70% of sales. Is that fine?
Yes.
If variable cost is 70%, you should know by now, the day before the examination, the balance of 0.3 or 30% represents the PV ratio, profit volume ratio, also known as a contribution to sales ratio, C by S ratio. Is that clear?
Yes.
Now remember this, y is a total cost, 3 lakh rupees is your fixed cost, 0.7 nothing but 70% is a variable cost, a percentage on X the sales revenue. If you understand this, it is a no-brainer. So simple this example. What are the questions asked?
Find out the following. Number 1, CS ratio.
Nothing but 30%, right?
Yes.
0.3. Next.
Next is a BE point, break-even point.
Calculate the break-even sales or break-even point. Here you can do only the break-even sales because we don't have the contribution per unit for you to find the break-even point in units. Then third question.
Sales volume required to earn a profit of 90,000 rupees.
Nothing about find the desired sales. Next.
Then number 4, sales volume when there is a loss of 30,000 rupees.
Again you got to calculate what will be the sales value in case you incur a loss of rupees 30,000. These are the 4 questions, 2 marks each, 8 marks. Just hold on to the catch. Fine.
Yes, sir.
Shall we?
Yes, sir.
So refer to the solution out there. Yes.
So given the total equation is y 3 lakh plus 0.7
X.
xy is equal to 3 lakh plus 0.7x.
Ah.
Where yy is the total cost, x is the sales revenue and fixed cost 3 lakh. Variable cost ratio is 0.7 or 70% and contribution margin or contribution to sales ratio is 1 minus variable cost ratio.
So it is 1 minus 0.7 which is 0.3 or I can say the PV ratio is 30%.
Percentage, answer 30% for
0.3. Okay?
Yes, sir.
And then a break-even point, we know the formula is fixed cost by PV ratio
PV
or
ratio.
C by S ratio.
Yeah.
Which is rupees 3 lakh by 0.3 which is rupees 10 lakh. You had to sell rupees 10 lakh worth of goods to break even. Third question you have been asked to find the desired sales, right?
Yeah, when the
You all know
profit is 90,000.
nothing but the target revenue formula can be applied. So the target sales or the desired sales equals fixed cost rupees 3 lakh and then add rupees 90,000 is a target profit or desired profit. The whole divided by PV or CS ratio 0.3. That means you have to sell rupees 13 lakh worth of goods to make this profit 90,000. Is that fine?
Yes, sir.
And the last question, use the same formula,
But there's a loss of
but
30.
that's a loss. So what you can do, therefore sales equals, it is 3 lakh
Minus 30.
minus expected loss rupees 30,000. divided by PV ratio 0.3, 2,70,000 upon 0.3 rupees, 9
9
lakh.
lakhs.
You saw that 9 lakh is below the 10 lakh break-even point. Whenever the sales is below break-even point, you will be incurring a loss. Is that clear?
Yes, sir.
So guys, with that we complete the solution. Bye-bye.
Yes, sir.